And welcome to Peter Davies' session today with Kill It or Keep It. This is post-entry analysis. Welcome, Peter. How are you doing today?
I'm pretty good, Dion. How are you?
I'm doing well. And it's evening over there for you, right?
It's yeah, just gone midnight right now.
Okay, so late one for you.
Yep.
Well, I'm looking forward to your session today. I'm pointing the pushing the URL into our room here for our chat community. Stop by that link there. We're going to have a screen share. Peter is in the lounge as well. Topics for today, we're going to be talking about using order flow, volume profile, trade size, intermarket analysis, and market internals. So Peter, are you all set? Turn it over to you.
Yeah, I am. Thanks, Dion. Okay, so thanks everybody for coming. Again, thanks as always for Top Step for hosting this. We've done quite a few webinars over the past few weeks. We've done really a lot of big picture, maybe we call it theoretical webinars that focus on order flow. And today we're going to do something a little bit different and something that's very focused just on one specific aspect of trading, and that's staying in a trade, or rather getting some breathing room in a new trade. So this isn't scalping. So we're not going to be looking at order flow from a scalper's perspective. We're going to be looking at order flow from a longer term day trading perspective. And the way that I operate when I day trade, I'm really focused on the first kind of part of a trade. I look at a lot of different things, but when a trade's gone my way a bit, I'm not so worried. I kind of try and let it run. So what we're going to look at is we're going to look at that early trade management. We're going to look at a bit techniques, almost exclusively for day traders, to actually identify trades that are not working out before they hit your stop. Now, we're not going to focus on entering the market at all because that really is just one aspect of trading. Okay, we will be entering trades at random, or if we're in the right location, we will be entering some intentionally dumb trades. Then we're going to watch those trades in real time and assess the state of them. We will have time for questions and answers. And this should give you something you can take away and start to apply in your trading if you think it fits. Now, the decision to cut trades is going to be based on two different types of information. First of all, we're going to do the order flow thing, looking inside the candlesticks to analyze certain aspects of the order flow. That's going to tell us if order flow is against us or on our side. Now, that might be different aspects of order flow than you would use to enter a trade. Okay, but we're going to look at specific things to see if it's on your side. But we're also going to take a look at the use of correlated or inversely correlated markets that can also help you assess the state of the market you're actually trading. Now, we will go through a number of elements that can help you identify if a trade is on side or not. And like all of the webinars we do, we're going to try and cover as much as we can, but I'm not suggesting that you suddenly try and use all these things. In fact, the best thing to do would be say, okay, I like the look of that one element. Okay, so I'm going to add that in and see how it works for me. Then decide if you want to keep that or not before adding in something else. Because that's what I've done. I mean, I can look at all these different things and I know when to look at one thing or the other. But I've added these things in over time. So don't think, oh my God, there's 10 things I've got to look at. There's no way I can do that. It's useless. Okay. Now we're going to focus on the S&P 500 because that's what I trade. These concepts are applicable to other markets, but you've got to do the homework in terms of what the correlations are and what you need to look out for. So what is the point of this? Why bother, right? Why not just get into a trade, stick with the trade, see if it works out or not? Okay, that's perfectly, a lot of people do that, perfectly acceptable. So if you average in on the ES, 5 contracts a trade, and you did 4 trades a day, and you traded 240 days a year, then one tick improvement per trade is going to make a difference of $60,000 to your bottom line. And when I say one tick improvement, I don't mean one extra tick profit from the trade. I'm talking about one tick improvement as in not losing a tick. Okay, so even if you've got a stop loss, it doesn't make a lot of sense to let your stop loss get hit if it looks like the market is going to hit it anyway. Okay, so if you're 3 ticks away from your stop loss and you've got a really good feeling that it's going to get hit, why not save the 3 ticks? Okay, now some trades just go straight against you right from the start and never go a tick on the side. Now that's pretty easy to spot, but in some respects those trades are the hardest ones to cut early because they don't actually give you time to watch the action play out. So the trades that are easiest to assess are the ones that kind of rotate around your entry point a bit after you get in. Now you don't have to cut a losing trade just because it goes against you. Okay, so if your trade's going against you, you don't have to just cut it because of that. So it's normal for a trade to go against you at the start. Certainly is for me. Where it gets kind of interesting is when a trade moves against you, say 4 ticks, and then it comes back to your entry price, and it just can't move through your entry price in your favor. It just can't even go a tick on the side. What's also interesting is when you get in a trade, it goes 2 ticks your way and then starts moving against you and can't make another tick in your favor. So it's those kind of scenarios that we'll be looking out for. But like I say, when a trade just goes straight against you from the entry point, there's not really a lot you can do to manage it. You know, if I buy and it just goes down 6 ticks to my stop, boom, I'm out, right? Now there are situations where cutting a trade isn't just jumping at shadows at the sight of a few ticks lost. So what we're going to do as we enter these kind of random or dumb trades, we're going to watch it for a little bit, but we're going to let it move against us a little bit. We're going to watch it and then kind of try and assess it once it's moved against us a little bit. Now obviously these techniques, they're not just to allow you to cut losers early. It will actually let you take a few more swings at the market, because once you get more proficient at working your way out of a bad trade, you can actually take more swings at the market, knowing when you're likely to be able to work your way out of a loser. And that's especially true on a market like the S&P 500, because the E-mini, it's famous for giving you second chances. It's very, very famous. It'll move away from you and it'll come back to your entry price and it'll just sit there at your entry price saying, come on, exit, exit, exit. And of course, a lot of people don't do that, but it's a second chance market, the way it moves around. Now, of course, whether you can actually get out or not is kind of important. You have to look at it's kind of especially true if you trade in a place where it's going to take time to move against you. Then you've got more of a chance taking a swing at the market. And that's something else we're going to be looking at when we get in, the potential for the loss to occur slowly or quickly, and the prospect of getting that second chance to exit. Now, there is a tendency to put your stop losses where everybody else does. So when you get stopped out, if it's at a time when everyone else is running for the door, you really want to be looking at getting out before that happens. So one of the things that some people say is, well, don't put your stops where everyone else puts their stops. And that's kind of an easy thing to say, but sometimes it's not such an easy thing to do. But if you know that your stops are where other people's stops are, then obviously what you want to try and do is actually assess the market as it's going to that point and trying to get out before they get hit. So once you've been through the theory of this, we'll put on some trades. We're not going to necessarily wait for a setup. It is in the afternoon, but it has been a bit of a rip today, so it should be interesting. If there's nothing setting up, we just put on random trades and look at the elements that we're going to look at. So what we're going to do first is we're going to look at the various elements that we will look at to assess whether to stay in a trade or not. Now, for me, the single most important thing to look at is the actual flow of the orders in the market that you're trading. Okay, so we're going to look at other markets and other things, but the most important thing is the flow of orders in the market you're trading. If that's aggressively against you and price is moving against you, there really isn't much else to consider. Now, if we look at the different screens we've got up here, there are a few different ways you can look at the order flow or the flow of market orders coming in against you. So, for instance, we can look at these center columns here. That is showing us the orders, the market orders hitting into the market. Size of the orders is important, but so is the pace. So one of the things that you're kind of looking at is how easy it ticks up versus ticking down. Okay, so right now, for instance, let's just take a look at this. Let's just see if we can get a market to tick down. Okay, we ticked up there and we ticked down again. Ticked back up. Okay, so those ticks up seem to me easier. There's a couple of ticks up. So we ticked up. So let's just watch it. Can it tick down? Okay, tick down easy. And let's see if it can tick up again. Okay, ticked up. Now, does it take a bit more time to tick down? Okay, is it even going to tick down? Okay, this is kind of a difficult thing to see when I'm just explaining it and you're not looking for it before. But the pace of the market ticking up and down. Now, you might come to a price, like for instance, we might come to this price here, 68.25. We saw 22 contracts trade. And we might come away from that and see another 30 trade. And come away from it and see another 50 trade. Okay? On the other hand, you might come to a price 3 times and print 1,000 contracts each trade. And if you're printing volume each time you hit that price, then you're a lot more likely to break through. So if it attempts to move through a price a few times, time's going to become a factor. Because once it sat there for a few minutes, the other side's usually going to come in and have a go at it. So when you're looking at the actual trades, don't just look at the time and sales. Don't just look at the numbers. Think about how is it moving up? How is the pace up and down, okay? The other thing we can look at is time and sales. Obviously, that's market orders. And you've got basically two ways to use time and sales. You can use a filtered or an unfiltered time and sales. Now, an unfiltered time and sales is a really good tool, and some people will just use an unfiltered time and sales because it does speed up and slow down, and you get that feeling for how aggressive people are hitting the market. I mean, right now, 68.25, we've got a lot of people hitting 68.25, a lot of people hitting 68.25. Now they're hitting 68.50. There's momentum upwards. I'm hitting 68.50. You can mentally picture in your head the pace up and down because you can actually see the numbers. So we can see it's come off a little bit. Now they're hitting 68.50 again. They're hitting 68.75. There's some pace and it's moving forward. So some people will use that. For me, I'm not a big fan of using an unfiltered time and sales because I just don't get on that well with it. It's just not kind of the tool for me. The other one you can use is a filtered time and sales. And the reason you use a filtered time and sales is to see size, is to see which size is trading. So if there's a lot of large players trading against you, that does not bode well for your trade unless they're not getting anywhere. So we just see 100 hit 68. Okay, so we want to see now, does it tick up from there? Or do some more large guys come on? So that guy who hit 68, okay, he's happy now. He's got 68.25. We've got 68.50. Do we get any more large buys in? We need a few more large buyers to kind of just say, okay, so we've got 68.50. Okay, so that's the kind of thing you want to see. You want to see a bit of size ticking up, a bit of size ticking up. Not a very difficult thing to see. So 265, 68.50. But now if we start to sit, if we couldn't tick up and we got some size 68.75 and we sit there, we know these guys that got in at 68.50 are in a little bit offside, in a bad position. And again, that's kind of fuel to the fire. So when you're looking at size, it's important to see size on your side, but it's very important to see the price progression as well. Okay. And then we're going to look at another way, and this is a kind of jigsaw thing. I'm not trying to push the tools down your throat. But I am from Jigsaw, so I'm going to show you the tools. This is a strength meter here. This one on the left shows me red is sell market orders, blue is buy market orders. So in a decent move down, you expect the selling to exceed the buying by 1.5 to 2 times. And again, that excess on one side, or that extra strength on one side needs to be accompanied by a price move. So what I did there is I just reset that, and we can see that since I reset it, we've got 3,000 buy market orders, 1,500 sell market orders. Now obviously that doesn't mean it's going to carry on up, But if that condition continues, we've got no reason to get out of the trade. And obviously also, if you were short at this point, you're not seeing what you want to see. You're really not seeing what you want to see there. Okay, so that's effectively order flow. And the key to reading info about market orders, very simple. If sellers are dominant, price will move down. If buyers are dominant, price will move up. Okay, it should be one-sided, 1.5 to 2 times on the dominant side than the other side. But there are times when one side is dominant and price stops moving their way. And when you see that, that's when the sellers are getting trapped, and that's when it starts to kind of come back in the other direction. And time is a factor. Time is always a factor. So, we've got that 69.75 now, 3,178 by market orders, hit 69.75, haven't got anywhere. So we had buyers dominant all on the way up, and then we got that size there. We got the buyers that hit into that price, couldn't get through it. Now, if you're in a long now, and you were long from 66, that wouldn't be a reason to exit the trade. If you were long from 69.25, you really should consider that you might be getting caught offside, because these guys are going to exit, and it will push the trade against you if they can't, at some point in the next 2 or 3 minutes, get up through that price. Okay. Now, limit orders are these things here. Obviously, we've talked about bids and offers before, and I'm going to kind of make some presumptions that you've seen the other webinars and understand what a bid and an offer is. And as we know, market orders eat the limit orders, and that's a key aspect to actually reading order flow, that we have that consumption of liquidity. The size of limit orders kind of varies day to day. The Nasdaq might be 60 to 200 contracts a level. ES normally 1,000 plus per level. The past month or so, it's been pretty thin. This is pretty thin for the ES, really. The higher those numbers, the lower the volatility, because it takes much more market orders to read through those limit orders. And also, the lower those numbers, the wider your stops are going to have to be on the ES, because it is going to slip and slide around. But the limit orders are really less important. And, sometimes I think one of the best uses for a limit order is if I was short right now and I saw this 1,000 here and my stop was above that, I'd probably say, well, if they start eating through that 1,000, I might want to consider getting out. So the limit orders are can be interesting from the perspective of giving you a bit of a line in the sand before you stop. If the market's moving down, so if we move down now, this 69.50, if we start to tick down, we go a couple of ticks down, really what you want to see as the market moves down, you want to see this 1,000 come down with the market. So if the market's moving down and you've got a couple of big orders moving down above you, then perfect, that's what you want to see. Now, on the other hand, if the market's moving down, if the market's moving down and suddenly you saw 3,000 here, 3,000 here, 3,000 here, that's not what you want to see. You want to see like 1,000 in this kind of market. We've got 600s. Yeah, 1,000 is a great thing to see following you down. If you've got 9,000 directly above you, it probably means the move's going to end. It's just fakery. It's just that somebody's trying to nudge the market around. So, the limit orders, it's not that important. You could get away without using it at all. But again, it is something that, if you've got the time and if you've got all those other things that you want to decide to watch under your belt and comfortable with watching them, then maybe you can start looking at the limit orders as well. And then obviously the other thing that's important is icebergs, and effectively what we saw up here at 69.75 was an iceberg, where effectively we had a certain amount of, I wasn't paying attention to the numbers, but we had offers here, and obviously those offers refreshed as we were trading into it. So when you see this big size, you can see it in two ways. You can see it because of the excess quantity traded there, but you can also see it because you'll start to see them adding numbers. And that kind of brings us to this kind of snapshot thing, this strange weird column here, which is just helping me see if they're adding or stacking orders. So basically, it is filtered right now. It's filtered only showing me, I think, 20 and above. So changes less than 20, it doesn't show. But it's showing me like right now 900 have been added to the offer at 67.50. You saw the 900 there. So that's all that does. And then what we can see, this big kind of blue bar here, that's like a visual graphical representation of the pulling and stacking there. And again, I wouldn't expect you to be using this and this. And sometimes, and to be honest, a lot of the time, the pulling and stacking this snapshot, really, it's kind of an entry tool for me. It's not really something I'd use to kind of stay in a trade. And then the other thing we can look at is volume profile, which is volume at price. We've done lots and lots of discussion on that. What the volume profile tells you in terms of staying in a trade. Sorry, there's a question of trading platform. This is NinjaTrader with the Jigsaw plugin. Anyway, so basically, the volume profile is going to tell you a few things. It's going to tell you where the stops are likely to be. It's also going to tell you where you're likely to get a second chance, and we'll go over that shortly. It's going to tell you where the price is likely to slow down and accelerate. So, like, if we look here, we've got this area of kind of relatively high volume, from what we traded here, and then we've got this low volume here. So we could probably expect below 65.75 for price to accelerate. So that's one of the things. If my stop loss is down here, and I'm starting to get through this price here, I might just say, well, it's going to whiz through. If it breaks this level, it's probably going to go fairly quickly through those 4 levels. So I'll just get out against that price. And it also tells you areas where order flow becomes sort of meaningless. Okay, and so let me figure it. I'll tell you an area where order flow will be fairly meaningless. Right here. Okay, so we've got this kind of thick area here. 1871 is one of the highest traded areas of the day. And so if you're in an extreme like this, like a 65.50, order flow is going to be really good, really good. If you're in this area here where all this trading happened, it's really difficult to read the order flow because it's just going to keep spinning around up and down. It's going to go bullish, bearish, bullish, bearish, bullish, bearish, just because it's in an area where there's been a lot of two-way trading. So when you get to an area where you kind of expect a lot of two-way trading, the order flow is not really it's not gonna help you a lot. Now, correlated markets and inversely correlated markets. Now, all of the markets have got correlated markets and inversely correlated markets. So, for instance, we all know the E-mini S&P 500 is a futures market based on the S&P 500 index, which is 500 stocks. So obviously, there's going to be a correlation between the S&P 500 and those 500 stocks. Okay, and that's where the evil HFTs and the spread, the arb traders, they're actually on your side in this case, because as soon as these correlated markets diverge, there are programs that kick in and arbitrage the difference. So quite often those programs are on your side and helping you because they keep the markets in sync. Now, there's some pros and cons for using a correlated versus an inversely correlated market. So what we got here, we've got one of the US Treasuries. This is a 30-year bond. Okay, and it's inversely correlated to the indices. Most of the time, I mean, we did have a breakdown in correlation recently for various economical reasons. But again, most of the time, these markets will be inversely correlated. So if the ES is going down, it will be going up. Now, one of the good things about seeing an inversely correlated market is, especially with the 30-year Treasury, is it'll be a bit, in this case, it's a slower market. And basically, you can just watch this center line, and if this is going down and this is going up, or this is just trading above here, then that's enough for you to stay in the trade. But what I would say on a day like today, if you look at the range on the 30-year today, compared to the S&P, it's pretty useless. So I'd say in a day like today, I wouldn't use an inversely correlated market. So for me, I used to use the Treasury as an inversely correlated market to stay on side of the ES. There's just something, I don't know what to say. There's just something kind of cool or nice or readable about having a market that's going in the opposite direction. But today it's going to be pretty useless, and I've been watching it today, and it really wouldn't have helped at all. So what we'll come and have a look at instead is the NQ. So the NQ is a correlated market. And with a correlated market, I mean, we're actually not just talking about, I mean, treasuries and stocks are kind of inversely correlated for various economical reasons. The S&P and the NASDAQ are correlated because they're both effectively based on the same stock market. Now, there are times again where that correlation breaks down. And there are times again when one of the markets is a clear leader and the other is a clear lagger. Now that's good to see. It's good to see. Sometimes you'll see the NASDAQ is leading the ES, right? But on the days where it doesn't, on the days where the NASDAQ lags the ES, it's still very, very useful for staying in a trade. So don't think that the market has to be a leader to help. Okay, that correlation is really useful even if the market's lagging. Now, we got two ways that we can look at the correlation. So I've got the NASDAQ here, I've got the ES here, and I've got a NASDAQ chart. And I'm going to get rid of this treasury chart because it won't do us any good today. So basically, I've got a NASDAQ chart here, and I've got the NASDAQ dome. Now, if I kind of clear these two domes and recenter them, you've got a choice if you want to look at a correlated market. You can look at the chart, or you can look at the dome, or you could actually look at the time and sales of the NQ. Although I think that would be difficult. And basically, sometimes if you actually look at the dome, it is a bit more flitty. It does kind of wiggle around a bit more, but you sometimes get a kind of more refined idea of where it's moving. Sometimes, if we look at where the black lines are when we recentered them, we can see how much the NQ has moved down from that line. It's sometimes just a bit harder to kind of get that level of granularity from the chart. What you're not trying to do with the NQ is you're not trying to read the bids and offers. You're not trying to read really the volume profile. You're just really trying to get an idea of how much it's moving down. So if I'm long in the ES right now, and I've got the ES moving down and the NQ moving down, it doesn't really matter if I'm using the chart or the dome, but I've got a pretty slim chance of being, having a successful long trade when those things are going on. Okay. There's a question there. There are multiple uses for order flow. Absolutely. My advice for order flow would actually be to use it for staying in a trade before you learn to use it for entering a trade. So let's just look at the final thing, okay? And the final thing is one of the market internals. Now there are a lot of market internals, and you've got to kind of just pick your weapon, basically. You've got to choose your weapon, because you can't look at lots and lots of different things, because effectively what will happen is you won't actually be able to make any decision at all. So I use the NYSE tick. And the tick, if you don't know, it's just a chart of how many stocks in the NYSE are ticking up versus ticking down. So if the last move in the stock was was upwards, then it's a tick up. If the last move in a stock was a tick downwards, it's a tick down. So the NYSE's got around 3,000 stocks, and this chart here is the tick, okay? Or kind of, it's not actually the tick. If you've actually seen the tick's kind of much a bit harder to read than this. So what this is just an average of the tick. So I take the high, the low, the close, add them together, divide by 3. And what you'll see is, earlier in the morning we had a little move up into the, a little push up. Then we failed, and then we can see since we failed, we've had these pushes down that are kind of quite wide, and then these little pushes up. that are quite narrow, and then the pushes down, the pushes up. So basically, it's just telling me what's going up and what's going down. Now, the S&P, the E-mini S&P 500 is an index of 500 stocks. The NYSE tick actually represents, like I say, about 3,000 stocks. There is an S&P 500 tick. Okay. Now, I guess conventional wisdom would say, well, if there's an S&P 500 tick, that represents those 500 stocks, surely that would be the better indicator for the E-mini S&P 500. Okay, and I think it's the JT6T on my feed basically. But I don't use that, and so basically my observation is that the NYSE tick is actually better at measuring the overall direction of the market, and it's like an ocean liner. It takes time to turn around, and the market tends to kind of turn around with it. If you look at the S&P 500 tick, it's a lot more volatile, and it tends to basically turn up and down with every minor move. So if you're kind of looking to say, okay, overall, is the overall market now starting to turn down? I kind of think you want to use the more slow labouring representation of the overall market than just the one that looks at the S&P 500. Other people will be exactly the opposite to me, and they'll want to use the kind of more whippy one. So when I'm looking at the NYSE tick, I'm actually looking at something that's kind of a bit more slow and laboured. Okay, and the only reason is I just found it better to use for me. Now, the other thing that we do use, and we've all seen this before, but it's not really for staying in the trade. We do use swing charts just to know the size of the swings. I mean, this really wouldn't help us much today. It's such a down day right now. It's kind of tough to take random trades, because probably the only trade you should be taking right now is a short trade. So we'll kind of leave that out for now. So those are the things that we're going to consider. And before we carry on, has anybody got any questions about what those things are? We're going to talk about how we're going to use them, but has anybody got any questions about what those things are? Okay, so while you're typing in the questions, we'll just talk about one other thing, and that's the stop itself. Okay, because a stop order is it's a funny kind of order basically, if you think about it. Right down here at 1864, well, that's going to disappear in a minute. Okay, so let's look at another price. Let's look at 1866. Okay, I've got 800 contracts at 1866. Which means 800 contracts need to trade before it goes through to the next price down. Okay, so with the stop order, if I put a stop order at 1866, as soon as one contract trades there, that stop order will be filled. Now, let's say you decide you're long, and you decided that the market was against you and the trade's probably a loser. Now, we all know it's a game of probabilities, not certainty. So you're saying it's probably going to go against us, but you can't be sure. If at this price, 1866, why stop out of the trade if only one contract trades there? So why not wait, in this case, till there's like 500 left, till 400 trade. If you see 400 trade into 1866, and you see that go down with no refreshing, that's when you can get out of the market, because there will be the odd occasion where it comes down to that price where you've got the bid and you wait for the 300 or 400 to trade, and that bid just keeps increasing and increasing and increasing, and that actually saves your trade completely. So that's not something you always need to do. I mean, on a day like today, it could be tough. I mean, we might have stopped tanking now, but there is a chance that, it's going to start coming in, pushing down again. So you have to kind of pick your days. But again, when you're looking at stop orders, don't get out just because one contract trades at a price. Okay. Which would work best with thin markets as crude oil? Well, the thing that always works best is always for me, it's always the order flow itself, the market orders, and also a secondary market. Those are the things I would use. I wouldn't use limit orders on something like crude oil. It'd be pretty useful. In terms of order flow together with conventional market profile, it's not really something to cover today because this is just about after we enter, and I only use market profile to really enter a trade. So what we're going to do is we're going to go through slowly a trade. And what I want to see today is people having an opinion. So if somebody thinks I should kill a trade, just say so, right? Because it's fine to be wrong. And I think it always helps people. If you start having an opinion and putting your opinion out there, it's probably the best way to refine your opinion. Now, the depth today is pretty thin. So we know immediately the market's going to be volatile. We've seen the range today, and it makes it a little trickier. I thought it was going to be tricky today because of the time, but it's not tricky because of time. But it is, obviously, if we take a short trade, then we're probably a lot more likely to be successful in the long trade. So let's try and figure out where to put a trade, and let's say we're going to be a perma fader, okay, and we're going to say, right, 1865.75, I think the market's going to get to that point and turn back up. It's not a trade I would take because of the overall sentiment being down, but let's just say that was the trade we're going to take. Let's just give it a couple of minutes to get filled. If it doesn't get filled there, I mean, it's only a sim trade. If it doesn't get filled there, then we'll just go in at market. But again, it's not a trade I'd take. I'm hoping that it actually doesn't work out. Because if it does work out, there's kind of not so much to see. So the first thing we said is don't start looking at it straight away. I mean, don't, give the thing a little bit of a chance to play out. I mean, if this just starts to dive now, then obviously you should get out, right? So what do we see? We see the order flow. We've got 400 contracts on our side, now 420 against. So, okay, right now we're about level. If we look at the volume profile, we're at a point in the volume profile, 13417. If it drops below there, we can probably expect a little bit of acceleration. And if it drops below 64.75, we can expect a lot of acceleration. So basically, where we are now is not in a very good position for it moving slowly against us. We're in a position where if this goes against us, it's probably going to rip. Okay. If we look at the tick, what's the tick doing? Well, the tick's kind of, it's not massively down, -309, but basically the tick had turned up. We had a move up, and now it's turning down. And if we look at what we've seen today, we've had lots of those little moves up and then these rips down. So the tick, okay, it's not terribly against us right now, but again, it's not what we want to see. We'd really want to see that starting to move up. The Nasdaq itself is actually now looking fairly good. When we entered that trade, you probably noticed a couple of things happened. The domes recentered. And when they recentered, they recentered on both domes. So we can actually see both the ES and the Nasdaq are exactly where they were when we entered the trade. So what we've seen basically is we've seen the market come down, go back up, and just kind of rotate around here. Now, if we look at the orders, we've still got slightly more market buying, the market selling, but we can also see that the market's come down. So let's just have a look at the size now. So we can see 65.75, 66, 66.25, 66 again, 65.50, 65.50. All of that buying there, okay, and look at where the price is. So we had all those large buy orders all the way up to 66. Sorry, where was it? Let me just make that a little bit bigger. All those big buy orders up to 66.25, and they didn't get any price progression. So right now, I think it's fairly safe to say the buyers are having a go, but they're not getting anywhere. Now, in terms of, obviously, we're getting actually to the point where we should really have already stopped out. But as you look down, let's just kind of move that out of the way. That's not because that's how I'd manage a trade, just because I want to kind of look at this. If we were looking down below now, what can we see? We can see a bid of 1,074, and it's at the low of the day. I mean, the chances of that holding are fairly kind of slim. But what we could do is we could say, okay, that 1,200 there is a price against which we'll wait for the market to hold. I mean, it's obviously it's one tick away from your stop. Doesn't help you much, but you can actually look at that price and say, okay, that's what we'd exit against. Now, I'm going through this slowly now, and as we do the next few trades, we'll go through it a bit more quickly. So let's move that back, and let's kind of consider what can we see now. We can see a market that's fairly even. The ticks moved up. Let's just watch the big trades, okay? So 66.25, we've got 106 traded. So they are not getting any ticks down right now. So let's just, okay, so we just got some big trades, 66.25, 66. They got some price progression down. We see 210 contracts coming with 66. He got a tick up. Okay, sorry, he didn't get a tick up. We got 121, 65, 75. The guy at 66 didn't get a tick up. Okay, so we can see this is the second attempt that the buyers have had of getting this market up, and they have failed. And I would say you should be getting out of that trade. You should get out of that trade. The buyers have had 2 attempts there at moving that up, and they've failed. And I just think at that point you've got to say, this really isn't a position I'd like to be in. Okay. Now I know that was a lot of different things to go through. Okay. So let's just basically go through that thing again. And what we're going to do, and obviously we can see it moving down now. We can see it moving down. It might not get through this big order, but what we saw effectively was big buyers hitting into it twice, not getting anywhere. And basically, if you see that, you need to get out. So what I'm going to do now, can somebody just say long or short? And what we'll try and do is we'll try and skip through that process a little bit faster. So come on, somebody just type in long or short. It's not about being right. It's just about giving a direction. Long. Okay, Chris wins 65.75. Again, bottom of this bulge in the volume profile. It's not a silly place to get into a trade, but we're in a downward market. The NYSE ticks at 160, 188. So far since I got in, trades are about even. I've got big buys up to 65.50. They have got price progression. They need to get another tick up. So let's just see. Okay, we've got a tick up again, but we couldn't hold that. So we ticked up to 66, came back down. Okay, we've got slightly more sellers than buyers, but it's only 470 versus 376. On the ES, you're going to see it's 1,000. Okay, so we now see the sellers coming in again. There's a bit of size at 65.25, and they got the price to tick down. Okay, so 65.25, the buyers are coming back, got nothing for it. Okay, sellers coming in. Okay, so you can see, we've got the selling now. You can see, if you're in a long now, this is not what you want to see if you're in a long trade. Okay, I can see the tick going down. The NASDAQ is below the black line, the black center line. I've got more selling, 64.75. Okay, they didn't get a tick down, yes, didn't get their tick down yet. Okay, buyers came back at 65. Let's see what they do. Okay, give the buyers a chance. They came at 65.25. They got a tick up. Can they hold it? And this is the thing now. This is the thing about second chances. It is absolutely amazing how many times you will enter a trade and it will come back with 1 or 2 ticks and just fail. Okay, and it's as if the market's giving you a second. It is a second chance. Somebody told me it's a second chance. It isn't like the market giving you a second chance. Okay, so let's look at this. 66, 20 contracts hit 66. And we've got 65.75, we had 135. Why does nobody want to hit 66? You need some buyers to hit 66. This is my second chance to exit. This is where I say, oh man, I'm going to stay in. It's really working out. It's really working out. And that's when it goes against you, right? So what do we get there? We've got another 80. We're at 88 now total there. 90 odd. We need the buyers at this point. You need some buyers. The tick isn't doing much. The NASDAQ's not moving up much. Okay, we need the buyers. This is your second chance. Okay, come on, we need the buyers. Okay, what will happen now, because we know we had the buyers there, everybody else is watching this as well. It's not just us watching this. If the buyers don't get the price possession, the sellers will jump on it. Sorry, price progression. Now let's look below us where we're going to exit if it comes against us. We've got 900 contracts at 65.50. We could say, right, this is my second chance. If the buyers can't push it up this time, I'm actually going to get out against this 65.50 price. I mean, there's 1300 down here, but that's so close to your stop anyway. And if it comes down here at 65.50, what are we doing? 700. If it comes to 65.50 and you get out and you lose a tick, just straight through me. So again, that's not what you want to see. 65.50, we've got 800. We've got overwhelming selling. We've got the tick coming down a little bit. Okay. The guys, just a chance, the guys at 65.50 have still got price moving their way. So again, for me, I don't want to see this. I want to see 4,600 sellers against 3,500 buyers. I know below me, price can accelerate. So again, I'd say it's just not what I want to see. I just don't want to see that. I don't want to see that. And look, so we're going down now. See if we can get through 64.50. What I want to see now, if we can move through 64.50 and get down a little bit, we might actually have a bit of a better condition for a trade. So let's just look at this. We just had that 1481. So let's go long there. And the reason I said go long there, we just had 1481 hitting 64.75, which is kind of the bidders stepping up. So you're at the step in the profile and a place where the bidders are stepping up. You've got some buys in there now. Might be a better place to enter. So at least we should see some activity because of that kind of iceberg order we saw there. So again, what have we got? The Nasdaq is just pushing up a tiny little bit. The tick is still down, but it is slightly moving up. Let me just make that a bit bigger. So the tick's going up a little bit. 250 contracts into 65. Okay, where's the tick up? Okay, we had absorption on the bid. We had the bidders stepping up. Why are they not jumping in? Well, we need a push up. You need this market to push up. Okay, it's not happening. Just think about this guy who put these people who put these buys in. Are they going to sit there forever? Are they going to put some more in, or they're just going to sit there forever? Because everybody can see this, and everybody's going to know that the longer that guy sits there, the worse he's going to feel, right? Okay, and then the sellers step in. Okay, and at this point, there's nothing below. You've got 1300 here, but that's at the low of the day. Okay, it's a very kind of tricky kind of saying. If you're at the low of the day, and I'm going to lean on that 1300 there. Sure, it's closer than your stop, but it's a bit tricky because it could just disappear very quickly. So what you want to see now, you want to see the 1300 move up. You want to see some size move up. Okay, the buyers did step in again, but they need to get a bit more traction. I mean, we're in this thick area here, but we kind of managed to kind of tick down a couple. Nasdaq's still going up. It would be good to see the Nasdaq get above this 43.25 level. It would be good to see the tick. You know, it's kind of almost neutral. It'd be good to see that start to turn positive, but just can't seem to get any traction. Got a few big sellers coming in again. But again, we've got this 1300 or maybe this 800 or the 1300 we can exit against. So we could stay in that trade, risk for 4 ticks. I mean, this is a typical perma-fader trade, right? This is a typical trying to buy the bottom trade. So this is the kind of trade that kind of doesn't work out a lot. This is the kind of trade that on a day like today, you might be on your 6th attempt at buying the bottom. But if you bought the bottom, okay, we've got this 1300 here. Tick's still not really pushing down. The Nasdaq's kind of making new, progression upwards. So it's not a terrible position we're in. We've just got some downside risk. We just had 1100 contracts flashing at 64.50. Is there any reason to use it on 30 seconds? Not really. I just kind of squash it up and it just looks nice. Okay, so we're kind of moving up. We're moving through this thick area. The 1300 is still where it is. Let's just see what the sellers are doing. We wouldn't obviously. Now you've got breathing room in the trade. Now you've got a bit of breathing room in the trade. You could actually scale some out of that point. Okay. So again, let's get out of that because we're not here to kind of hit targets and stops. So now we're in a position, if we want to take a trade, Do I do this? I do this with, yeah, so you're asking, I do this with every trade, but I'm not talking about it. And it's like, it's not, I'm not kind of thinking about it as aggressively. I try to, um, what's the word? I try not to overthink it. I mean, to be honest, you can probably look at this, the big size more than anything, and this one here. Those are the two most important things. But when it starts to go against you, you've got to say, okay, it's going to go against me now. Where am I going to get out? Have I got a big bid there? If I've got a big bid there, it's probably fake. But if it comes down to this 65 now, and look, it was 800 there, it's gone down to 691. Then I can get out. I know those guys are pulling out of the way. I mean, it's gone down to 500 now. So like so as it comes down, if I see them pull out of the way, I can think, well, that's probably going against me, and then try and think about, do I want this to go against me on an 8-tick stop, or do I want to just take a couple of ticks? If I'm trying to catch the bottom here, which is a very, very tough trade, I don't want to keep losing 2 points catching the bottom, because if I take 3 or 4 attempts at catching the bottom, that's 8 points. There's probably not going to be that much upside in it. Okay, so any more questions at this point? Okay, let's do another one. Let's do another one, okay? So again, if we look at where we are contextually, right, we can look at what the market's doing. It's kind of in a range now, 64.50, well really, 67.25 has been the top. So if we look at that, 67.25, 64.50, I mean, so that's probably the places that you want to sell and buy right now, if you could get there. The problem is we're right in the middle now. So let's just take a trade right in the middle. Can somebody tell me short or long? Short the NQ. I don't trade the NQ. Buy. Okay, buy. Right, now let's just have a look at this, because one of the interesting things, right, if you buy in the middle, if it keeps rotating, I mean, this could just drop now, but if it is going up, it'll probably rotate around these prices. So let's just let it go and see if we can get one of those scenarios where it just does the kind of rotate. So we can see we're mostly red on the sell side. We've got some big sellers in now. If it does get through this 64.75, then we're not going to see that rotation. If it does get up through 66 again, this will just go all blue, and then it'll just kind of flip-flop. And because you're in an area where you're kind of expecting two-way trading, this kind of analysis will be fairly useless, but you shouldn't, that really isn't a great place to buy unless you're seeing a lot of momentum. Okay, but we can see 1,000 versus 700, 1,000 sells, 700 buys. They're selling 64.75. Are they getting a tick down? There's no bids below us, right? There's nothing below us. This is a precarious position to be in a long. The tick is making some fairly good pushes down, but the Nasdaq really isn't doing much right now. Okay, it's made a push down. So can the Nasdaq, since we got in, the Nasdaq got down to 43.75, can it get down any further than that? If we break this 64.75, we're pretty much toast. Okay, so let's just see it play out. I was hoping that it would kind of rotate around these prices so we could see the kind of way the two-sided thing plays out. Okay, we've got 2,800 sells, 2,200 buys, not really anything in it. Selling at 65, selling 64.50, okay. But they're going to come in now. Watch the sell side and watch the tapes as they take this down. Okay, so they're selling the low of the day. Look at that. Look at the size on the sell side. Look at all the sell orders on the tape. 6,300 against 2,900. Okay, so we didn't really have a good warning for that, but it just shows when it does make a push. Now, what would the perma-fader do now? Perma-fader is going to buy that. Okay, so let's buy that. Okay, so what do we want to see now for a perma-fader? We want to see some buying. So they're buying 64. Do we get a tick up? I've got 1,100 contracts here, which is what we're going to exit against. So let's just move that one below there. So at 64 buying, it's not got a tick up yet. The delta is pretty even on the buy and the sell side. The NQ still hasn't made a new low. The low's down here, but it's pushing down. There's 64. There's no large size either side. We've just got some mostly small ones. Okay, there's some more size. 64. They got a tick up. 3 contracts at 64.25. Want to see a tick up again and see how many contracts trade at 64.25. Because this is the kind of action when it does this kind of ticks up, doesn't trade much, ticks up again, doesn't trade much, ticks up again, doesn't trade much. That's kind of an easier thing to read. So we want it to just tick up again and see if there's any buyers, and just see if those kind of buyers disappear. Okay, so price isn't moving anywhere. We can see 1,200 sellers against 834 buyers. We can see the Nasdaq's flat. We can see the tick is just starting to come back up a little bit. Okay, now we've got some size. You can look at what's happening here on the bid. They've added 1,000 to the bids. They're showing 50, 60 contracts, but 1,100 have traded. Okay, so basically they were showing a really small amount of contracts, 1,100 traded. So there's some sellers trapped at 63.75. Okay, buyers need to respond. So we've got buy at 64.50. We're at 64.75. We need another buy. We need another buy. Okay, this is a bad trade. This is a perma-fader trade anyway. It's a push down base. It's pushed down through the low and we're buying it. So 65. So we've got to be ultra cautious, right? So 64.75. Okay, the buyers need to push it up again. I mean, we can't even get, we can't even get like a, what's that? 1, 2, 3, 4, 5, 6 tick pullback. Okay, so okay, the buyers are buying 65. Sorry, 18 at 65. Okay, so yeah, they bought 65. See if we can get some size. Okay, so there'd be no need to. You could put a break even on that. You should get that to tick up now. Okay, there you go. Okay, so is that the most confusing thing you've ever seen, or could you actually see yourself using some of those techniques in your own trading? So have you got any questions about any of those particular things that we've looked at? Okay, Ross, where's the best place to see someone trading using Jigsaw? You have to get up very early in the morning to see that, Ross. We do have a trade room that where we have a trader that trades the bund in the afternoon that you can watch that guy trade, but we don't do anything during the US session, basically. Do you need all the columns on the NQ? Absolutely not. Absolutely not. I mean, really, the NQ, the only thing that you're interested in on the NQ, I mean, you could take the bids and offers off, but it would kind of look a bit weird. The only thing that I look for on the NQ is it relative to the center line. So again, when we put a trade, let's just do another trade on. You see that they recenter. So I'm kind of more interested in whether it's below the center and how much it's moving through the center, and when it comes back, like now, it's gone down 4 ticks. Okay, now it's pushed down again. So it's going to come back. Can it push down again? And if it keeps pushing down, and the tick's pushing down, then I'm kind of happy to see it. But you're absolutely right. I mean, the volume profile can help on the NQ, but you got on the ES. I think it's probably a bit of overkill to try and read everything on every screen. I mean, you can see, right, the NQ is moving down. That's all you really want to see. NQ is supporting the move. The ES isn't following, and you've got somebody stepping up on the bid again, adding contracts. But effectively, the only thing you need from the NQ is it ticking down, or if you use an inversely correlated market, is it ticking up? Volume, RC, when you say is the volume not important, you mean volume at price, or like volume per minute, that kind of like on a candlestick chart? Yeah, well, volume profile on the NQ, yeah, it might be. I don't know. I don't really, to be honest, I don't know why I've got it there, to be honest, but I've never said, I'm going to get out of this trade on the ES because we're at a step in the profile on the NQ. Okay. What are the two blue and red buy sell columns above the filtered time and sales? Okay. Basically, this is the buys versus the sells, and then this one's a snapshot. Okay. So the way this works, right? Wait, if this ticks down again, this one on the right is going to go neutral. Okay. So it goes blue. We want that to go red. You want that to go red. That stays blue. That's bad. What that is saying, right? It's representing how much is pulled or stacked. So basically, if they add to the bids, which they're doing, it adds to the blue. And if they pull from the offers, it also adds to the blue. So it's kind of saying if you add contracts to the bid or pull contracts from the offer, that's bullish. And if you pull contracts from the bid and add contracts to the offer, that's bearish. So basically, this is a kind of thing that you want to see. Basically, as it moves up, you want to see a tick up, it goes all blue, tick up, goes all blue, tick up, goes all blue. And then when it starts to kind of decide to tick down again, you'll see it'll go all red. Okay, so now we're seeing it go all red. We want it to come down. We want it to tick down. We want that to kind of go to spike down all red and then try and get a tick down. Okay, now it's gone all blue. So it's kind of a bit of a skittish indicator, but it's just an indicator to get a quick eyeful of whether they're pulling or stacking contracts. Yeah, for me, Eek, the filtered size helps me more because I always think in terms of stuck traders. So you got sellers selling into 63.50 now, but they didn't get anything for it, and then the buyers came back in 63.75. So the buyers did get a tick. Now the buyers bought 64, and we got 64.25. So I like to think in terms of the buying size and getting a tick up. Now 64.25. What happens when we get to 64.50? Okay, if we get to 64.50, let's just clear that above. So I bought 64.25. Can he get a tick up? And the longer that sits there without a tick up, the more likely it is to go down. Okay, so if he trades like 64.25 and doesn't get a tick up for 30 seconds, there's nothing wrong with that. If it stays there, okay, so now we've got a lot more people bought 64.25, 2,200 contracts traded there. That's more guys sitting at that price waiting for a tick up. And these guys that trade this kind of size, they don't have 8 tick stops. They're out of the market, in and out of the market very quickly. So you saw what happened. They didn't get anything. The 2,300 contracts traded, and boom, the market collapsed. And it basically collapsed because those guys tried to push it up. They were part of the reason for that collapsing. Okay, so does that make sense? The market is very cooperative sometimes when we do these webinars. I'm quite impressed. Any other questions? Okay, so I think we're good for questions. So Dan, I think really we can kind of finish on that note. I'm more than happy if people want to ever do this again, just sit through and just kind of do this and just kind of talk through the trades. But effectively, you could just pick up one thing. You could just pick up a filtered time and sales and just say, put in your head, right, I'm just going to look at size. I want to see size move the price, and if size doesn't move the price, and it sits there for a while, I'm going to expect it to go in the opposite direction. Or you could just say, I'm just going to use the nicey tick. I'm just going to see if the tick's on my side. Or I'm just going to use the NASDAQ. I mean, look at the NASDAQ charts. The NASDAQ chart would be helpful right now. Would have been very helpful today. I mean, this kind of day, I mean, I'm glad we weren't doing this in this rip down. At least we had some kind of, market nudging around a bit. Anyway, so that's, I think we finished a bit early there, but that's effectively the kill it or keep it, basically. Just trying to look at different things other than just the price on the chart to decide if the trade's working or not. So if we don't have any more questions, I think I can hand back to Dion.
Well, all right, Peter, that was an excellent, intensive training that you just presented for us. Appreciate the live interaction with the market like that, giving us some plays as it's going about, providing that analysis. I mean, that's fabulous stuff.
Yeah, I know. When I told somebody earlier I was doing that, I was thinking, what could possibly go wrong?
Well, you're giving your commentary on
Yeah.
it. You might not necessarily take those trades, but you're providing the analysis on what's going on in the market in real time.
Sure.
And
But I mean,
so
trading's all about having an opinion, right? So I think, for all you guys out there as well, I think that one of the biggest turning points for me in being able to read all this stuff was having an opinion and sharing it. So if you do have a log or a blog or something that you can actually put your trades out there and why you took them, and sometimes explaining that stuff afterwards really helps you to cement it in your own head.
yes, excellent. And so, Peter, where would someone go if they want to begin? How do they begin with your material that you have here?
Well,
Do you have suggestions there?
if you're currently trading and saying, right, I'm currently trading and I'm using a fixed target and stop, or I'm using a fixed stop, I would say the correlated market is probably the easiest. I mean, if you're looking at an ES, if you're looking at an ES chart, you could look at a currency, you could look at one of the bonds, you could look at one of the other indexes. That's the easiest thing to do, is to see if there's another market backing you up. So I would start there. But I also think the big trades, looking at the big trades, because it's just amazing how often you just see them get. I mean, we've seen it today. It moves around, they get stuck, it moves the other direction, someone else gets stuck, moves around. I mean, it's a nice thing to see.
Right. All right. Well, this is a session by Peter Davies of Jigsaw Trading. It's called Kill It or Keep It. It was about post-entry analysis, and it has been recorded. So, Peter, we thank you so much for your time. It's the evening over there, and I know your weekend has begun already.
Yeah, I'm already in trouble. It's actually my first wedding anniversary now.
Oh, wow. Well, congratulations.
Yeah, you imagine how much trouble I'm in right now.
All right, well, we better let you go then.
Yeah, it's okay. My wife's asleep, but I certainly have to wake up early in the morning and take her for breakfast and shopping and all that kind of thing.
Absolutely. Well, thank you again.
Yeah, no problem. And good luck, guys. And as usual, I'm always around on the top steps. If you've got any questions about this afterwards, send me an email or catch me on Monday, Tuesday when I'm back in the room. And thanks a lot, Dion, for hosting this.
Well, you're very welcome. Excellent.
Okay.
Well, this is Peter Davies, and we thank you so much, Peter. Have a great evening. We'll talk to you later.
Okay, thanks, and bye.